What's up, everybody? Welcome back to the channel. My name is Vukasakhecapital and I am the director of Vukasakhecapital. I want to thank each and every person who's here today, who's been very supportive and very encouraging of the past videos that we've been doing. I've been getting a lot of positive feedback, so I just want to send a shout out and a thank you to each and every one of you. Obviously, those of you who are here for the first time, welcome. I want to thank you also for joining us. This is part of our Financial Literacy 101 series, where we're talking about the basics of financial literacy and financial education concerning the different asset classes and how anybody and everybody can get involved if you wish to. Now, if you wish to contact me, you can contact me on my social media platforms on Instagram and Facebook under the tags Vukasakhecapital or Masonabe Chobonga. That's where you can contact me if you have any questions or queries, or you just need for us to consult. Or you can just email me at vukasakhecapital@gmail.com. It's vukasakhecapital@gmail.com. Therefore, anybody can just send me a request, and I'll try to respond to as many people as I can. So yeah, I think that's about it. Let's get into it. Okay, before we begin, guys, I need to highlight and stress that before you take this information and run with it, please do speak with a financial advisor, your financial advisor, someone who's regulated under FSCA Code of Conduct and has an FSP license, meaning they have the authority and are regulated to give you sound financial advice for your future. It's very important for me to highlight this because this is the best way for you to be empowered and for you to make a money-savvy and informed decision about yourself after realizing your entire situation. This is just purely for educational purposes and for us to empower each other. Okay? So let's begin. Today we're going to be talking about the asset class referred to as equities. Now, we're not going to go too in-depth with this, but we're just going to be laying a foundation so that everybody can have a basic understanding into what equities is. There'll be further videos in the future whereby we go more in depth. Okay, so first of all, let's define it. Equities, guys, in basic terms, is ownership. It's ownership into an asset. So when you own an asset, either a company or something that generates income, you have ownership over it, meaning therefore it gives value to you because obviously it creates returns. Anything that operates for you, that creates returns, that you have a stake in, a percentage into it, that's an equity stake into something. It's an equity. Now, the most common form of equity obviously is company shares. So when you buy shares into a company, you own a certain proportion of it. Now, this was started a long time ago, and I'll make a separate video about the history of shares and equities because it was done during the trading times. I think it was in the Dutch times in Netherlands, when they needed obviously to do shipping and they didn't have much capital, so they put money together and then the first company was formed, the first company. So anyway, that's a separate video. Today, we're going to be talking obviously about the different types of one, the basics. So we're going to be talking about the main three, which is public, private, and home equity. Okay. The first type of equity that we're going to be talking about is the one that everyone is most familiar with, which is the publicly traded shares on the JSE. Now, I want to make a very clear distinction here because a lot of people I've noticed get it mixed up, thinking that the JSE market is the same as the South African economy. Gandhi, this is not a thing. They're very different things. The JSE market is basically the Johannesburg Stock Exchange, meaning that we're a publicly traded company, meaning that when a company wants to offer its shares to the public, that's where it goes. It goes to that organization. It's an SRO technically, meaning that it's a self-regulatory organization. So it operates on its own. It's an organization, so it's not a government department. It's an organization, but it does report back to the Treasury. So the JSE is in itself operating just for that, and a market where buyers and sellers sell and buy shares of a company. But the South African economy is something completely different. It's the GDP, the operations, the functions of a country, meaning its import, its exports, its production, and everything. So sometimes these things are not always connected. So let's say the South African economy could be struggling like it has been for the last couple of years, but its basis of it has more exports than imports, because South Africa, last time I checked, I think exports around 100 and something billion, while it only imports 80 something billion. So the balance sheet is okay-ish. You know, we're not good, but we're okay-ish. Whereas the South African JSE, which is the stock exchange, operates on just the public companies and the shares and the buying and selling. So before we go into public companies, I just wanted to make that distinction. They don't always work together, but they're very two different things. So anyway, like I was saying, the public equities are basically shares, like I said, of a company, a portion of them that are listed so that anyone or everyone can purchase them should they desire to. The reason why most companies do this is to raise capital. So they have shareholders within themselves, the people who started the company, the people who manage and run it. And then there are board members, meaning the shareholders who own equity into it, and as well as selected members who are elected for special positions, like an elected chairperson or someone like that. Even a CEO. CEO doesn't necessarily have shares into a company, although most CEOs do end up purchasing shares into their own company so that they can have a more larger stake into it. But in normal business, a CEO is just a person who is hired. So anyway, a public company is just that. It's a company that lists its equity onto the JSE, and anyone and everyone, like myself, can go purchase a share into Sasol, BP, All Mutual, Nedbank, Standard Bank, yeah, whatever. All those companies listed on the JSE. So the clear distinction between this and a private company is that a private company is where the shares are not listed on the JSE, but they can be for sale. This one is a slightly more difficult to get to because you never know who has shares for what. Like my company, Vukasakhecapital, it's a private company. So the shareholders in this company are not open to the public. Like no one can Google who has shares into Vukasakhecapital. But I, as the director and the majority shareholder, I know who are the board members and I know who has what percentage of shares. Okay, so the listing of my shares is totally up to me, and anyone that I sell it to, I get to choose who I can sell it to. So that's the thing. When private companies issue shares, those are private. That's private equity. Public companies, meaning that they listed on the JSE, they have to follow regulation, which states that they have to be transparent with their shareholders. And since the public is a potential shareholder, all the information that they share has to be disclosed, so you can Google things and find things out of what are the shares, what are the market cap, meaning how much does the company make, what are the returns every year, and everything. So yeah, that's the clear distinction between a private and a public company. The reasons why people sell shares are usually the same. Again, it's either to raise capital so they can purchase more shares. So they can purchase more assets. This is usually like when a company is starting out, so it's raising capital so it can get established and grow. Or if it's already established and already functioning, usually it raises capital so it can expand. So to purchase land and to purchase larger assets to finance its projects and things like that, so it can increase its revenue. So there's different reasons why companies raise capital by selling equity. It's just a very long-term basis, because when you're buying shares on a publicly traded company, it's very easy to sell the shares that you own because there's a market for it. But in a private company, one of the cons is that you can't really sell it quickly, because the shares that you own of a private company, they're not so easy to sell because people don't know about that company, okay? So when you do want to sell it and make a profit on it, it has to go through a long process where the company gets assessed by the potential buyer. It has to go through an approval period of all the other board members. So there's just another process. It's slightly more intricate, but this is why when you go into equities, you need to be sure where you're going to be investing, because there's also individuals who can purchase private equity for you. So another scheme, I'm not going to say scheme, it's a strategy, is when people go on the JSE, they purchase a large number of shares and then they delist them. So they send a letter to the JSE and the board members telling them that these shares that we've bought on the JSE, we are taking them out of the JSE for them to be privately held. So you see, that's another process. But now usually that means you're either going to be doing a takeover somehow, or you just trying to hold as much equity for a very long-term perspective, and you want to have a more strong foothold. So anyway, that's just another business strategy. The reason why I wanted to highlight these things is because these are the most common ones for companies. These are the different types of equity in companies. The third component is obviously equity into an asset like a household or a property. This one is slightly more detailed in the sense that when you purchase a property, if you purchase it cash, the asset is yours, meaning that the total equity, the value of it, is yours. You have 100% equity. But when you get a bond on a home or on a property, when you put a deposit, that value is the equity that you have in a household. Let me make an example. Let's say there's a property worth $1 million. If you put in 100,000 rands as a deposit, meaning that 900,000 rands, or the remainder of the million, which is 900K, that value is the debt associated with that property, meaning that you owe the bank or whoever 900,000 rands. When the bank is evaluating how much interest they're going to charge you, they're going to base it on the 900,000 rands. So let's say they charge you 10%, meaning that it's going to be 90,000 rands. So the 10% plus the bond plus the debt is 990,000 rands that you have to pay back to the bank. The 100,000 is the only portion that you own of your property. Okay, so that's your equity. You're 100,000 into your property. Most contracts, when you're purchasing a property, have this thing whereby you first pay off the 90,000 rands, which is the interest charged to you. So remember that 10%? That's the interest that was charged to you. So in the first payments that you're making towards your bond, let's say, this is hypothetical, I haven't done the numbers, but let's say you're paying back 9,000 rands, 10,000 rands every month. The first 9 payments, meaning 10,000 for 9 months, those ones first pay off the interest, that 90,000 rands, meaning that you haven't touched your equity. You haven't done anything to it. But if you make payments, let's say of 2,000 rands extra, so instead of paying 10,000, you're paying 12,000 every month towards your home, your bond. What's gonna happen is that the 2,000 excess amount that you're paying in the recommended minimum payments, that 2,000 rand goes towards your equity. So for those 10 months, you are paying, those 9 months, sorry, you're making those 10,000 rands, the 10,000 goes towards the interest payments, those 9 months, and then the 2,000s that were adding up go towards the 100,000. So now your equity is growing into your household, into your home. By the time it accumulates, what you can usually utilize your equity for, which is what brings me right now to the conclusion of all of this, the reason why you purchase equity is so that you can have leverage, because equity is an asset. Ownership into another asset can help you finance another asset. In the previous videos that we did, when we were talking about property and we were talking about cash, those are the fundamentals of assets, the different types of assets in the easiest phase. But when you're utilizing credit or utilizing leverage, meaning that you go get another loan or a loan with a bank, what you do is you always utilize the loan to purchase an asset. Every time you take credit, try and purchase an asset, because an asset will be able to create returns for you and income. And that income will pay back the loan, you know? It's like a cycle. There's an asset, there's a loan that you take from the bank to purchase an asset which creates income, and this income pays back the loan, you know? It's like a cycle. So if you keep this balanced and you do this like a number of times, you keep doing this, you start slowly, and then you get into the habit of reinvesting into yourself, meaning that you purchase more assets by using those assets to create income. That income pays back the debt, and then you get more debt, but the right kind of debt. We're gonna make a separate video where we talk about the different types of debt and the right kind of debt. But for now, I just wanted to highlight equity can also be used as a leverage mechanism to get another loan or another debt, to get more debt, which can be able to purchase another asset. So this is how you can also build a real estate portfolio. The more equity you have in holdings, the more you can use it as leverage onto your next property by saying, hey, I've got another asset plus a down payment, meaning that a deposit. So now you can use this one to feed the next one, to feed the next one. And then you just make sure that your assets are making money. Because the day that one asset stops is when the machine stops, okay? So be very careful in how you strategically place your assets. There are some assets which are tangible, some are intangible. Like also there's something called, brand equity. So a name like Coca-Cola or Apple or Nike, those are brands, meaning that those companies can put value onto those names because the general public understands that company just based on the brand itself. They've grown accustomed and trust it. So now every time, like if Nike says we make the best shoe, no one is ever like, you're lying. I mean, we might have a difference of opinion saying that, no, I like Puma, I like Adidas or whatever. But if Nike says this shoe that we're releasing this summer has been tested, it's the softest, best shoe for running, it beats everyone, we guarantee it. We will just take it at face value. It's just something that we do subconsciously. We don't even pay attention to it, but we'll be like, oh, Nike's bringing out the best shoe in our conversations when we're talking. And that's something called brand value or equity, brand equity. So a company can also sell that. They can actually sell that and say, I want to sell the name of my company. So the company might be struggling financially, but if they sell it to another company and say, we want to add value onto this by putting the name along with the deal, so that you can also purchase equity into the name, meaning the rights of purchasing it. An example I want to make of this is that, I don't know if you guys know about Off-White, the brand. The founder of it was Virgil. So Virgil is a designer, and he sold his company Off-White. But now when he sold it, he holds the rights to the name, meaning that Off-White is trademarked to him. So he held on to that value, but I think he made, I'm not certain, I think about $400 million. But when he sold it, he sold the company so he can go work for Louis Vuitton, I believe. Yeah, LVMH. So he sold that, went to go work for there as a designer, but he still earns royalties off the name because there's value into it, okay? So every time people put a name put that name on a product, he gets a share of that sale. So as I said, when you're purchasing a share of an asset, that is equity. I just wanted to close it off there. So whenever you're going to be investing into equities, just make sure that you understand that whatever form of equity that you invest in, there's pros and cons, but you should be smart enough and do the research enough by being well informed so that when you do purchase an equity stake into something, you know the value of it, because that can help you leverage and build your wealth to build bigger and better things for yourself. But anyway, I'm sorry, I'm gonna cut it off there because I'm not trying to make this videos too long. I believe that sharing is caring. So please do share this video with your friends or your family or anyone that you feel like is interested in going into equities. By the way, just to also add this in, there's something called brokers. Brokers are the intermediary between you and the sale of equities. So there are stockbrokers. Stockbrokers are the ones that help you purchase shares into a company. Let's say you want to purchase shares into Apple. Even if you're South African, you can purchase shares into Apple. You just need to find the right broker who can be able to purchase it for you in dollars, okay? So there's individual stockbrokers, but then there's organizations, meaning that your bank, if your bank has an ability to trade on the JSE on your behalf, meaning that you can purchase it using their app online or their private banker, so that organization becomes your broker. Standard Bank has it. A lot of the normal banks have that option. So you need a broker to purchase equity for you. And a broker that most people take for granted is a real estate agent. A real estate agent is technically a broker because they help you purchase property from a holder of property. So they're your intermediary. So with all of these types of brokers that are there, they have a fee that they charge to you, so brokerage fee. So you must be willing to pay it. It's usually between 15 to 20%, depends on the type of asset, but that's the usual range. 10 to 20%, actually, I'm just going to put it there. 10 to 20%. So when you're purchasing assets in terms of equities, be aware that there are charges that come with it. So you need to budget for it, you need to be aware of it, and also accommodate it, because these people help you build wealth. So always pay your people. That's something that I'm trying to encourage a lot. Always pay your people. I'm tired. Let's cut it off there, guys. Please do hit me up on my social media, on Instagram and Facebook, under the tag Vukasakhecapital. Give this video a like, subscribe, and hit the notification bell. It really helps support the channel. Email me at vukasakhecapital@gmail.com. I don't know why I always start with at. But anyway, so just email me if you have any queries or questions, and it'll help basically us to communicate. If you need any assistance, like I said, all this information, guys, is not to be construed as financial advice. Please do have a financial advisor. It really helps you have the right mindset as well as the right research behind you to know what you're doing. But otherwise, guys, I really appreciate your time. I hope everybody learned something beneficial from this. Yeah, and I'm just here to help, guys. Have a wonderful day. Cheers.